Why the call for a correction that you've had for quite a while now? Why do you think that's the right place to be?
Yeah, thanks, John. I mean, look, patience is a virtue, I guess. I'm not sure I have patience, but this is not a new call for us, as you know. The mid-cycle transition has really been playing out since March. It's happened at the stock and the sector level almost perfectly. And then it usually ends with the high quality index finally taking its turn. And it's time now, right? So we've been patiently waiting, and we always felt like, we got to get to when the Fed gets to remove, maximum accommodation. That's always part of the mid-cycle transition, whether it's 94, 04, and 2011. Now we're there. It's this week. And by the way, that doesn't mean it's the end of the world. I mean, I want to remind people, the fact that the Fed's removing maximum accommodation is a good outcome. That means that the recovery has, happened, and we're moving in the right direction. But it comes with consequences for financial assets. And, the economy is not the market, as you know. Last year, the markets were spectacular. The economy was not. This year, the economy is spectacular, and markets have been more difficult at the stock and sector level, and ultimately that ends with a correction in the major averages. Now, the reason we kind of stepped on the gas a little bit today with our note is because we actually see that, the amplitude of this cycle, whether it was the downturn itself or the recovery, the V-shaped recovery, it's been extraordinary. It's been bigger and bigger amplitude than normal, which would suggest that the mid-cycle transition should also be bigger than normal, meaning the deceleration will be greater than what is typical. And that would be the ICE scenario where the revisions actually are quite negative for a couple of quarters, and that may embody a bigger correction.
Is there something in the price action that has given you the encouragement, Mike, to lean more towards the so-called ICE scenario?
Yeah, well, John, you and I know each other pretty well. You're spot on, as usual. Friday, we finally got that crack on the 50-day moving average. It has, everybody's been so focused on. And as you know, I mean, we are very disciplined around, what the market is telling us. And so, we felt like it was gonna crack overnight. It did. And look, price is probably one of the single most important determinants of people's behavior, right? All of these things that people are talking about today are known, right? Whether it's a situation with Evergrande, whether it's a situation with deceleration and growth that we've been talking about for 6 months, whether it's the fact that the Fed's going to be moving away from maximum accommodation. These are known facts. But the price was ignoring them, and people were ignoring them. And now, with the price breaking, that gets people to pay attention to the facts that were in front of them the whole time.
We've got to work through this then. You're looking potentially for something that looks more like a 20% drawdown. You're leaning in that direction, Mike. I wouldn't call it your base case just yet. You can if you want. I'm trying to understand from your perspective then how you'd guide people through the drawdown as it develops. Many people have been told if there's a dip, buy it. I want you to help our audience distinguish between a dip worth buying and a dip worth avoiding.
Yeah, well, ultimately it's a recovery, and I don't think we're going to have necessarily a double dip recession, but it may feel like that in the short term. So I would say the recommendation we're giving our clients, we did the same thing with our clients last week, is look, be patient with this particular dip, right? The dip has been to buy every time at the 50-day, but we took that out now. So now you have to change your behavior. You have to say, I'm not going to be buying the first dip here. I'm going to wait. It does take a little time. And so for me, from a timeline standpoint, corrections are always about price and time. And so from a price standpoint, I think it's 10 to 20%. Great. But time, I think you've got to get through the third quarter earnings season. Let's see how the revision breath kind of plays through that. Let's see how the market digests the Fed moving towards tapering by year end. So to me, it's sort of 2 to 3 months. I think you've got to be patient in here. Let's see how this goes into basically the fourth quarter.
Is it too early to make a call on where the leadership comes from next, Mike? Do you have to watch this play out before you make that call?
No, we've made that call already, John, as you know. I mean, we pivoted towards quality back in March, and then we pivoted further this summer towards defensive quality. We upgraded even utilities. We're overweight staples and healthcare. Those were our favorite 2 defensive areas. Yeah. And I think that's the place to be right now. I think you want to be kind of defensively oriented, defensive quality, and then you've got to have other stocks in your portfolio too. You can't just own that, but that's where we'd be overweight.
Well, allow me to rephrase the question. What I mean, Mike, is when you come out the other side of this drawdown, a lot of people are already making the call on what the leadership will look like through the rest of the cycle. Do you think it's premature? Do you have to watch the drawdown completely materialize before you make the leadership call for what comes next?
Yeah, I think now I understand your question. I think absolutely the market will show its hand. And, we're big believers in relative strength. So we will see where the relative strength comes from in this drawdown. And then we will probably, skew our portfolios in that direction. My instinct tells me that this is a reflationary cycle. So we do think you'll probably want to have definitely some of these reflationary stocks and then cyclical stocks in that next phase. People, I think, we got premature and started buying that, 2 or 3 weeks ago. We avoided that. But I think that's going to be definitely one part of the barbell. The other part of the barbell is going to be growth stocks. It's just you can't overpay for them, right? And so a proper drawdown may make some of those growth stocks attractive again.
So, Mike, you're leaning in this direction. Final question for me. What would make it the base case? What would you need to see to make it the base case cool?
Well, I think it's going to be a function of the fundamentals. So, I mean, our real call here is that we think earnings revision breadth is going to flatten out and even turn down sharply. So if we start to hear that and see that in the data over the next 2 weeks, it's kind of a foregone conclusion. Now, we showed in our note this morning, John, consumer confidence has already rolled over sharply. We think just mathematically the PMIs will head back towards 50 by year end.
Yeah.
Okay, that's normal in any mid-cycle. And those are already suggesting that you should get a 20% drawdown. So that's why we wrote the note this morning. I mean, like, there's already plenty of indicators that suggest that's where we're going. And, so the icing on the cake for me will be if earnings revision breadth come down. But I want to make it perfectly clear, right? This is normal. This is what should happen. It's just
Sure.
It's more extreme, like this whole cycle has been.
So, Mike, final question. Allow me to squeeze this one in. How would you know if you're wrong? What would be the tell?
Oh, well, I think, clearly price action, if we somehow, reverse here quickly after a 5% drawdown and we get back for the 50-day, and then all of a sudden, maybe the Fed doesn't move forward this week and actually says, we're gonna pause on this. We see another fiscal stimulus bill from the government that's really directed right at, kind of the consumer again, checks going out, and maybe China, same thing. They do a big fiscal stim. Those are potential variables that we would absolutely have to take into an account, and because it would change our forecast on revision breadth and PMIs and all of that.